Sky News Real Estate. Smart Investing.
Hello and welcome to Smart Investing. I'm Chris Gray. On tonight's show, why do so few financial planners recommend property, and how do you find one that does? What is an investment-grade property and how does it differ to any other property? And what can you do to invest for the highest possible return and the lowest possible risk? Well, joining us tonight is Stuart Wemyss from Pro Solution Private Clients and Charles Tarbey, Chairman and owner of Century 21 Australasia. Welcome to the show and thanks for coming up from Melbourne. Now, you've just launched a new book called Investopoly. Do you want to tell us a bit about what you do and what the book's all about?
Sure, Chris, and thanks very much for having me. So Investopoly is all about the 8 rules on how to build wealth, and the reason why I wrote it is that I believe that building wealth is actually really easy, and if you have a good understanding of sort of the framework and fundamentals of how money works, then it's really easy to work out what your investment strategy should look like. So as an independent financial planner, that's why I wanted to put that book
Now,
out.
we have very few financial planners on the show because none of them seem to recommend property. So the next obvious question is why do so few financial planners recommend property, and why are you a massive advocate? Because in your book you talk about it all the way through.
Yeah, absolutely. Well, I mean, property is one of the key growth asset classes. In fact, it's worth more than the Australian stock market. That is the value of Australian property. So it's ridiculous to ignore one key component. Why don't they recommend it? Well, I think vested interests is the main problem, and then secondly, they don't understand it and they've got no experience in it, and it's a big problem. So that's why I think independence is key when getting financial advice. So someone that knows equal amounts about shares and property.
Now, Charles, I remember even when I came out of school 20 or 25 years ago, they talk about independent financial planners, but in a way, most of them aren't independent, are they? Trying to get independent advice is pretty hard.
Well, it is very hard, and some of the better ones actually do focus on property because, and look, they can earn a good living through focusing on property. And if they didn't focus on it the last 5 or 6 years, I'm not sure they've done the right thing by their clients. So your financial planners were where you went to, just like you went to the bank manager back then too. Nowadays that's all changed as well, of course, luckily. Luckily,
exactly, and the Royal Commission's talking about all this, is it really independent? Now, Stuart, we're going to run through some of the key goals for the book, just in case people don't buy the book, but we're going to tell them how to get it later on. Sure. Your golden rule number 1 is play the long game. Tell us about that.
Yeah, so I think, Chris, the best question you can ask yourself is what can I do today so that I'm going to be financially stronger in 10 or 15 years' time? And don't worry about what's going to happen over the next 1 or 2 years. So it's not really a question of what will the stock market do or what will the property market do over the short term. It's really what's the best decision that I can make today so in the long run I'll be much better off. And I find a lot of people are just too short-term focused, and that's really rule number 1.
Now, Charles, you've always talked about your kids on the show quite a bit. You got them investing pretty young. Yeah. And again, whether they invest in shares, property or business, they just need to do something, don't they? They do, and luckily for my children, they started early and they were in the property market before the last boom cycle and probably before the one before that. But it's getting that start is the hard thing, and I think now it's harder, it's becoming easier and easier for them because the market's changing again in people's favour. But it is a long game, and you know, when my daughter had an issue with the tenant, she said, "Oh, Dad, maybe I should sell." I said, "No, that's not a reason. You know, you keep the property, you keep moving along." And I can tell you about the long game because it's been a long game, and it does work. It does work. You can sit on property and be there for 10 years and nothing happens. And all of a sudden it changes just like that, and it really is just like that. And that's the thing, because quite often we talk about some property doubling every 7, 10 or 12 years, but it's not consistent, is it? It suddenly, it goes flat and then it goes bang. Yeah, absolutely. And the other thing too, Chris, is properties always seem expensive. You know, no matter when you bought it, if you bought it in the 80s or 90s, 2000s, it's never been cheap. And that's the problem, is that people can't then take that mental leap between, okay, this is what I'm going to pay $1 million for it today. How could it be $3 million or $4 million in 20 years' time? Yes. But it does. You've got to play that long game. Charles, without me taking the mick too much, how much was property when you were a young lad? Okay. And so how many would you have bought in hindsight if you knew how much they would have gone up to now? I always talk about the first home I ever sold in real estate back in the early 70s, and it was a 3-bedroom brick veneer home in Emu Plains, 1 street away from the river, fully furnished with a Hillman Hunter in the carport because the people were going back to the UK.
$18,500. And I think the Hillman Hunter would be worth more than that now, to be a collector's item. So I was looking in an agent's window actually last night, pointing out a property and saying that, you know, 30 years ago when I was selling that house for $27,950, and there it is for $650,000 for sale. You could have bought.
But at the time, it would have been a fortune, wouldn't it?
Well, a lot of people struggle. I think everything's relative, as you're saying, and it does change. Relativity changes sometimes when the price is a bit higher than the salaries, but it always sort of comes back around, which we can see that right now. And yeah, people were making offers back then. If you had a chance to buy a property at $27,950, you'd say, "I'll take 10."
Yeah.
But of course, people were making offers even back then.
And that's what I think our kids would be saying. It was only $1 million. Why did you only buy 20, Dad? You should have bought 50 and I wouldn't have to work. Yeah. Golden rule number 2 is know how much income you need and by when.
Yeah, you don't need a map until you've got a destination, Chris. So people come into me and say, well, I need an investment strategy, and I ask them 2 things. How much income do you need per annum and by what age? And typically I met with blank faces. So it doesn't have to be, you don't have to be really detailed about your goals, but you've got to have something to aim for. So I would say for most people, go for 60, because that's when you can access super, and so super can come to play in your investment strategy. And then in terms of how much you need for living, just a good proxy is what you're spending today.
Yeah. Charles, so many people that go and buy property or they go into shares, again, I guess it comes to the rule number 1 is they're going short term. They're just looking at a finite amount of time. How many people do you reckon actually do any of this planning?
Yeah, not many at all. And I think when you look at the stock market, it may increase better than real estate over a period of time, but you've got to be in it, you've got to understand it, and there's so many parts to it. I think with real estate, it's just nice and simple. You buy something. We always say you're selling an average home to an average couple for an average price, and they keep it for an average period of time, and they make money out of it. So I think that playing real estate for a bit longer than normal is the way to go. I just had a property that I've had for 10 years, a commercial property, commercial floor, and it sat at this certain value for almost the last 10 years. And just in the last year, in the city of Sydney in Strata, it's virtually doubled in value, just in the last year.
Whereas some people would have just caught short, sold it just before it's gone up.
The most important thing I notice between people who really succeed and those that don't do as well is that they're not there when success arrives. They leave just that little bit too early.
Patience.
That's true. Your next one, golden rule number 3, is sometimes wealth creation is so very simple. Your third one is spend less than you earn, invest the difference.
So, Chris, it's not the income that you have, it's the size of your surplus cash flow. So that is everything that's left over after paying for commitments and expenses and so forth. And it's the consistency of that surplus cash flow. You know, so if you're spending everything you earn, I'm not a magician, it's going to be very difficult to build an investment strategy.
And then the next one, number 4, is actually grow your asset base and then concentrate on income later on. So most people are straight, I want a positive cash flow property, but it's all about actually growing your assets, isn't it?
The analogy that I draw, Chris, is about playing golf. You know, you wouldn't tee off with a putter. You'll get to the green in the end, but it'll take you a lot of shots and it's inefficient. But a much better way is to, as I said, grow your asset base, then start tilting towards income.
Now, Charles, you're a golfing man. You even own a golf course as well. So if you're going to play golf, you may as well buy the golf course as well.
You're going to give me a free promotion, are you? Yes, I do own a golf course.
And I've never seen so many Century 21 signs all over a golf course.
Thank you very much. That's all part of owning the course. Sometimes there are downsides to owning
free advertising.
But nonetheless, it's there. I'll give you another analogy with golf, and I say to people when you're teeing up, if you are slightly out in your alignment here at the tee, you're 50 metres out down that end. And so it's really important that what you do right here now, and what you're talking about, that base and that foundation, is set really nicely, because you could head off in the absolutely wrong direction right from the very first moment. And I've seen people do that, and they go out and buy property because they've been told they've got to get into the market. Getting into the market is not the answer, because if you get into the market in the wrong place, you'll sit there for a very long time and make nothing but loss.
Yeah.
But again, is the whole thing about, I guess, compounding is if you're suddenly getting in your 20s and you've got 40 years investing versus getting in at 30 or 35 when you think you've got more income, suddenly if you've only got half the time period to make up the money, it's very, very hard.
Time's a really important component. The more time you have, the lower risk you can take, and the reverse is true as well. So absolutely, starting early is absolutely key, and you really don't need to get a lot right, as long as you don't get anything wrong. You know,
you don't need supersonic returns.
That's right.
Your fifth one, before we go on to Charles, is set your asset allocation to reduce risk and maximise your returns.
So there's not a lot written about property and volatility and so forth, and volatility is obviously how much prices change. In the stock market, volatility is about 20% across all different markets, Australia and US. In Australia, volatility in property is about 10%, so half of that of the stock market. So volatility is a good measure for risk, you know. So if we're a low-risk investor, do we want all our money in the share market? Well, we're going to make friends with the 20% volatility rate. Compare that to residential property in Australia, and I just took the average of Melbourne and Sydney with that number. So it's really about having a portfolio of mixture of assets that really represent your risk profile.
Real estate's slow, that's the issue.
Yep.
When you see people making money and you look at Bitcoin, the number of people that ask you, oh, you know, because they feel like they're missing out on something, and they're not willing to take and play that long game that you're talking about, because it really is that. People say, oh, you know, what, 10, you've got to wait 10 years. 10 years goes like that.
Yeah.
And
the slow, I think, is the advantage, because then people aren't going to jump in and out, which makes it non-volatile, and then that's the whole upside. Well, perfect time, Charles. Let's talk about the auction numbers around Australia.
Yeah, they've been very interesting. The change is still quite dramatic. 60.1% was the clearance rate for the national perspective. 73% last year, 73.1%. But Sydney itself only had a clearance rate of 60.8%. So it's dropping, and that's just from Sunday. That's all going to go downward from here on in. And that was over 669 auctions. And Melbourne didn't fare much better either, at 64.2% with 1,028 auctions. But there wasn't a single capital city this week that did better than this time last year. We've had a couple like Canberra and Adelaide have come in and out of that bracket, but not one capital city actually beat this time last year. So there is a big change coming through, and we've talked about it. The agents need to adjust, and the best way they need to adjust is when they're listing property for sale, they need to set the stage for change at that point, not down the end of the transaction when somebody makes an offer. Which
effectively is a cheap salesman. A cheap salesman, they just go in nice and easy, we'll get you a record price, and then they run into problems later on.
Reward for effort, Chris. That's my industry, reward for effort. Anybody that wants their money before they put in the effort, you've got the wrong person.
Now, homes advertised for sale.
They're down, actually, slightly, and it really doesn't make a lot of difference, down 0.33%, because over this time last year we're still up 5.31%. So I think the stock levels are good and strong, and they really are a good indication for buyers who have been sitting on the fence to start coming in, because I see a price adjustment in certain marketplaces occurring in a downward level, and people need to be ready for it. Get your finance approved and get ready to do something.
Now, what about what's happening with rents?
Yeah, interesting stats with you, because I've been keeping them since January 2014, some of these stats. So I thought I'd give you an indication of what's really happened. 0.23% is what they are down this week over last week. But here's the big one. Our Perth is down 20.51% in rent values since January 2014. Hobart's down 16.72%. But here's the one that scares me a little bit, and this is the one we've spoken about. That's Hobart. It's up 23.67% since January 2014. That's the biggest growth rate across the entire region in the last 4 years. Now, what does that tell you?
And literally everyone's been tipping this Hobart, like it's just been in every prediction thing since, I guess, a year ago.
A little bit scary for me.
Yeah.
Right now, a little bit scary.
And again, most of us investing in property don't want those massive returns, because chances are it can go down the other side as well.
And it has done on these other capital cities.
Yep.
And I guess the same with the vacancy rates, Chris. The Perth is still high, 9.33, better than this time last week, but not a great deal better. Sydney came in 2.77, but the winner, Melbourne, 0.54%. So 4.21% for the average for those three capital cities.
Wonderful. Thanks for the update, Charles. We'll see you again. Now, we're going to take a short break, but we'll be back soon.
You're watching Sky News Real Estate. Smart investing.